We've all heard of market bubbles, and many of us know someone who's been caught in one. Although there are plenty of lessons to be learned from past bubbles, market participants still get sucked in each time a new one comes around. A bubble is only one of several market phases, and to avoid being caught off guard, it is essential to know what these phases are. In this video, we'll learn exactly those different phases, which are essential for every single investor. Hello and welcome to the Market Watcher, a place for gathering traditional financial knowledge on a regular basis. Subscribe to the channel and like the video if you don't want to miss out any of our content. No matter what market you are referring to, all go through the same phases and are cyclical. They rise, peak, dip, and then bottom out. When one market cycle is finished, the next one begins. The problem is that most investors and traders either fail to recognize that markets are cyclical or forget to expect the end of the current market phase. Another significant challenge is that even when you accept the existence of cycles, it is nearly impossible to pick the top or bottom of one. But an understanding of cycles is essential if you want to maximize investments or trading returns. Here are the four major concepts of a market cycle and how you can recognize them. The first phase is called the accumulation phase. This phase occurs after the market has bottomed and the innovators, meaning corporate insiders and a few value investors, and early adopters, meaning smart money managers and experienced traders, begin to buy, figuring the worst is over. At this phase, valuations are very attractive and general market sentiment is still bearish. Articles in the media preach doom and gloom, and those who were long through the worst of the bear market have recently given up and sold the rest of their holdings in disgust. However, in the accumulation phase, prices have flattened, and for every seller throwing in the towel, someone is there to pick up at a healthy discount. Overall market sentiment begins to switch from negative to neutral. The second phase is called a markup phase. At this stage, the market has been stable for a while and it is beginning to move higher. The early majority are getting on the bandwagon. This group includes technicians who see the market is putting in lower lows and higher highs, recognizing market direction and sentiment have changed. Media stories begin to discuss the possibility that the worst is over, but unemployment continues to rise, as do reports of layoffs in many sectors. As this phase matures, more investors jump on the bandwagon as fear of being in the market is supplanted by greed and fear of being left out. As this phase begins to come to an end, the late majority jump in and market volumes begin to increase substantially. At this point, the greater fool theory prevails, valuations climb well beyond historic norms, and logic and reason take a backseat to greed. While the late majority are getting in, the smart money and insiders are unloading. But as prices begin to level off or as the rise slows down, those laggards who have been sitting on the sidelines see this as a buying opportunity and jump in en masse. Prices make one last parabolic move, known in technical analysis as a selling climax, when the largest gains in the shortest periods often happen. But the cycle is nearing the top. Sentiment moves from neutral to bullish to downright euphoric during this phase. The third phase is called a distribution phase. In the third phase of the market cycle, sellers begin to dominate. This part of the cycle is identified by a period in which the bullish sentiment of the previous phase turns into a mixed sentiment. Prices can often stay locked in a trading range that can last a few weeks or even a few months. For example, when the Dow Jones Industrial Average peaked in 2022, it traded down to the vicinity of its prior peak and stayed there over a period of several months. But the distribution phase can come and go quickly. For the Nasdaq Composite, the distribution phase was less than a month long, as it peaked in 2022 and moved higher. For the Nasdaq, the distribution phase was quite shorter. When this phase is over, the market reverses direction. Classic patterns like double and triple tops, as well as head and shoulders patterns, are examples of movements that occur during the distribution phase. See the provided charts for examples. The fourth phase is called a markdown phase. The fourth and final phase in the cycle is the most painful for those who still hold positions. Many hang on because their investments have fallen below what they paid for, behaving like the pirate who falls overboard, clutching a bar of gold, refusing to let it go in the vain hope of being rescued. It is only when the market has plunged 50+% or more that the laggards, many of whom bought during the distribution or early markdown phase, give up to capitulation. Unfortunately, this is a buy signal for early innovators and a sign that a bottom is imminent. But alas, it is new investors who will buy the depreciated investments during the next accumulation phase and enjoy the next markup. Below you can see an image of all four cycles and how they look. With this chart, which exemplifies our video, we end this lecture. Subscribe to our channel, like the video, hit the bell icon of course, and do not forget to leave a comment about what videos do you want next on our channel. Thank you for watching until the end, and I'll see you in the next video.